How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Welcome back to the weekly banking update, as it were. So I hope everyone is having an awesome week out there. I think we're going to start off today by I'm just going to hit some highlights of some news that I was not able to get to in last week's episode, just because we kind of ran out of time. So just to run through some of the headlines here. So we had higher for longer Fed stance weighs on community banks' first quarter margins and deposits. So community banks across all U.S. regions reported generally worse net interest margins in the first quarter as they grappled with a higher for longer interest rate environment. Definitely a theme that we'll see as we go throughout the news here today. U.S. banks with under $10 billion in assets that reported earnings as of April 26 posted a median net interest margin of 3.15%, down from 3.45% a year ago. All five U.S. regions reported lower median net interest margins year over year during the quarter, with the West posting the biggest drop of 48 basis points. CRE concern, again, higher for longer outlook drive on the so this is called the Sun HomeWest deal amendment. So regulators sensitive to commercial real estate and the for higher for longer rate outlook led to First Sun Capital Bancorp and Home Street Inc. amending their merger agreement. The recently amended agreement includes a slew of changes, such as raising more capital in conjunction with the deal, lowering the exchange ratio and termination fee, and extending the expected closing timeframe from late 2024 from mid 2024. So again, so you can see how the higher for longer is affecting some of the M&A deals. The trend of credit unions buying banks reaches Louisiana with the second biggest deal ever. So we had credit unions continue to acquire banks across the U.S., and the buying spree is once again on a record-setting pace. Texas Dow Employees Credit Union announced acquisition of many Louisiana-based, I guess that's the name of the town, Many, M-A-N-Y, many Louisiana-based Sabine State Bank and Trust Company marks the eighth deal announced involving a credit union buying a bank in 2024, with U.S. bank M&A remaining subdued while credit unions stay hungry for deals. Credit union deals now make up 21% of all U.S. bank deals announced through May 6th. So U.S. banks leap leisurely over $50 billion in assets, but remain cautious of $100 billion in assets. So U.S. banks are no longer reluctant to jump over the $50 billion asset hurdle, either through M&A or organic growth, as they were in past years. So since policy changes in 2018 that rolled back certain regulatory requirements for banks between $50 billion and $100 billion in assets, more U.S. banks have surpassed that threshold. So since 2018, 16 banks crossed that mark, including New York Community Bank, which has had a lot of problems, First Horizon Corp., First Citizens Bank shares, and Western Alliance Bancorp, compared to just 3 between 2012 and 2018 that are still operating. So New York Community and other multifamily lenders cut exposure as concerns persist. This, again, is a common theme right now of banks unloading their existing loans, existing debt, particularly around office and multifamily properties. So several of the U.S. banks with the largest reported multifamily loan concentrations reduced their exposure to the segment in the first quarter amid signs of weakness and continued stress in commercial real estate. Among banks that reported multifamily exposure in first quarter filings, many of those with the highest proportion of multifamily loans relative to total loans held for investment included First Foundation, Kearney Financial, and Blue Foundry Bancorp. New York Community Bancorp, which said it anticipates elevated loan loss provisions and charge-offs through the rest of 2024 after receiving its CRE loan portfolio, reduced its multifamily loan balance by 1.1% in the first quarter to $36.86 billion, or nearly 45% of its gross loans held for investment. So we got New York Community was the cheapest bank at the end of April. For the second consecutive month, New York Community Bank was the least expensive bank in S&P Global Market Intelligence analysis. As of April 30th, it traded at 30% of adjusted tangible book, nearly unchanged from 29.9% at the end of March. So maturities and portfolio maneuvers soften damage to banks' bond holdings. So maturing securities and portfolio management are taking some of the sting out of the impact of higher interest rates on the value of banks' bond holdings, as expectations for a rapid series of cuts by the Federal Reserve have evaporated. Rates across the curve have rebounded this quarter, compounding unrealized losses on banks' available for sale AFS portfolios. For the 15 largest publicly traded banks in the U.S. together, accumulated other comprehensive income, otherwise known as AOCI, which captures such losses, worsened $6.26 billion sequentially to a negative $144.52 billion in the first quarter. So in other words, banks' bond portfolios continue to remain underwater and at a very, very large number. Top CRE lenders trimmed exposure in the first quarter amid ongoing stress. Many of the top U.S. bank lenders on commercial real estate office properties trimmed their exposure to the sector in the first quarter. Of the 55 banks in the S&P Global Market Intelligence analysis, Wells Fargo, Bank of America, and PNC Financial Services had the largest outstanding office books as of March 31st, according to the data reported in public company filings. All three, with a long host of other top lenders, including First Citizens Bankshare, Citizens Financial Group, and Truist, posted sequential reductions in the first quarter. So again, we kind of see this theme persisting here. U.S. corporate bankruptcies in April reached the highest monthly level in a year. So U.S. corporate bankruptcy filings in April rose to their highest levels in a year as companies continue to feel the burden of high interest rates. A total of 66 new bankruptcy filings in April, up from a revised 61 filings in March. The pace of bankruptcies has accelerated since the start of the year, though the 210 filings recorded over the first 4 months of 2024 is marginally lower than the 224 recorded over the same time frame in 2023. Investor group targeting failed banks between $5 billion and $30 billion in assets. So Portico's Capital Corp is eager to scoop up large community and small regional banks as high commercial real estate concentrations and depreciated bond portfolios continue to weigh on the industry. In 2023, an investor group came together and got approval from the OCC for a shelf charter, a mechanism that allows private equity and other non-bank entities to acquire failed banks. So it's kind of an interesting business model, as it were, right there. So okay, so done with that pile. Now let's get on to the kind of regular news here for this week. So let's see, what do we got here? Morgan Stanley agreed to acquire $700 million of property loans made by the failed Signature Bank from a venture including Blackstone, Rialto Capital Group, and Canada Pension Plan Investment Board. Bloomberg News reported, citing people familiar with the matter, the Blackstone venture bought about $17 billion of Signature property loans from the FDIC in 2023 and announced plans of selling $1.8 billion of those loans earlier this year. Fulton Financial Corp's Lancaster, based out of Lancaster, PA, based subsidiary Fulton Bank and Fulton Financial Realty Company agreed to sell 40 financial center office locations to certain affiliates of Blue Owl Capital for an aggregate cash purchase price of $55.4 million. In addition, Fulton restructured a portion of its available for sale investment security portfolio by selling approximately $345 million of investment securities and reinvesting the proceeds into higher yielding securities of a similar type and duration. The company expects to record a pre-tax loss on the sale of investment securities of approximately $20 million. This was interesting. So Bank of America, they had an investment banker named Leo Lucanis III, and he died last week. Unfortunately, God rest his soul. But apparently from another interview, apparently he wanted to exit the firm because he was working more than 100 hours a week. And this gentleman named Douglas Walters, who was a managing partner at Gray Fox Recruitment, he told Reuters this in an interview. The news outlet reported that it has no evidence that long working hours contributed to Lucanis's death. A bank spokesman declined to comment. I mean, that, again, working ridiculous hours in that end of the business that's not a new thing. I mean, that's been going on for decades and decades and decades. I just thought it was kind of interesting that like this gentleman passed away and then this was what came out. It was just, I don't know, just kind of an interesting thing that caught my eye. Okay, what do we have here? This is kind of interesting. Wells Fargo and Company introduced a new policy that prohibits advisors from accessing Facebook's business pages. Financial Planning reported, citing people with knowledge of the matter, the bank's access ban is related to Meta's ability to capture, monitor, and archive data from the sites. So it's kind of an interesting thing. Chicago-based financial exchange CME Group is planning to launch Bitcoin trading and has been in talks with traders who want to buy and sell the cryptocurrency on a regulated marketplace. The Financial Times reported, citing 3 people with direct knowledge of the discussions. BlackRock Inc.'s advisory vote for the approval of the compensation packages of its top executives, including that of Chairman and CEO Larry Fink, got only 58% of shareholder support, down from 92% of votes it received for the executive pay proposal in 2023, Barron's reported. Citing figures from the company, a shareholder proposer aimed to separate the company's chair and CEO roles fetched only 10% of votes. Coinbase Global is developing a service for Australia's self-managed pension sector as it eyes potential demand in the segment, which has allocated $1 billion to cryptocurrency investments based on Australian Taxation Office's latest data. All right, let's see what else we got here. The Canadian House of Commons Finance Committee will meet May 17th to discuss recent allegations of drug traffickers laundering fentanyl money at Toronto Dominion Bank, otherwise TD Bank. Reuters reported the Canadian banking giant has invested over $500 million to upgrade its anti-money laundering program amid a U.S. probe on the matter. So that's kind of interesting. Okay, and then we had a couple more crypto things here. So cryptocurrency hedge fund Block Tower Capital Advisors has been hacked, compromised, and partially drained. That doesn't sound good. Bloomberg News reported, citing people familiar with the matter. With the funds still missing and the hacker not yet caught, Block Tower hired blockchain forensic analysts to address the matter and informed its limited partner about the heist, the report said. Block Tower declined to comment on the hack. Dublin-based Circle Internet Financial Limited plans to shift its legal base to the U.S., Bloomberg News reported, citing a company spokesperson. As for the report, the spokesperson confirmed that court paperwork for the USDC stablecoin issuer to re-domicile in the U.S. was filed recently. Bankrupt financial technology company Kabbage, doing business as K Servicing, has reached a $120 million settlement with the U.S. Justice Department for its alleged role of the False Claims Act in its participation in the payroll protection program. The FDI. Okay, I'm going to have more on this in a minute with the FDIC. We're going to talk all about what's going on with the FDIC. I'm going to save that for a minute. Let's see here. The U.S. U.S. SEC and the U.S. Treasury Department's Financial Crimes Enforcement Network proposed a rule requiring registered investment advisors, and exempt reporting advisors to establish, document, and maintain written customer identification programs to boost anti-money laundering safeguards. It's a mouthful. Okay, this is interesting. So in a report titled "Can the Discount Window Stigma Be Cured? An Experimental Investigation," economists at the Federal Reserve Bank of New York urged the Fed to rethink its contingent liquidity plans for banks, given that the stigma around the Fed discount window facility has become deeply ingrained among practitioners, which may be impossible to cure. So that's a pretty interesting thing. I'm definitely going to check out that report and see kind of what it says, what the conclusions are. I mean, it sounds pretty interesting there. And just for people that don't know, so the Fed has the discount window that not every bank can use. Basically, only the big prime banks, the 24 main prime banks, are allowed to come use the Fed discount window. But there's a stigma around borrowing from this window. I mean, basically the stigma is that if you're borrowing from the Fed discount window, you are in trouble. And so a lot of banks just, they don't want to do it. So again, so it'd be interesting to check out that report and see what the deal is. The U.S. Treasury Department's Financial Stability Oversight Council released its first report on non-bank mortgage servicing, which identifies key vulnerabilities that can impair servicers' ability to carry out critical functions, amplify shocks to the mortgage market, and pose risks to financial stability. So I'm going to actually talk about this in another episode that I'm working on. There was a really interesting interview with PNC CEO where he talks about this, and then it's also addressed in a bank report. So basically what's happening is the bulk of mortgage loans today are not made by bank. They're made by what you call non-bank, entities. And so there's a lot of question now around like, well, if we have a major crisis, can they survive it? Like, can they deal with the issues there? Okay, let's move on to some other things here. Hearings target FDIC following misconduct. Oh, again, okay, so I'm going to come back to that again. That's a FDIC. So let's see here. So consumer price index increases in April. The consumer price index increased 0.3% in April after rising 0.4% in March, which I found almost comical. The markets, if you were looking earlier this week, the markets reacted very positively to the fact that the CPI was down. But if you also recall from a couple of days before that, the government, I believe, removed coffee beans from the calculation, thus achieving their goal of getting the number down by a hair. And everybody across the media reported that, oh my gosh, inflation's going down. It's heading right on back to 2%. It's complete and utter nonsense. So inflation is not going back down to 2%. It's not going to get it. Inflation is where it is. It's going to stay at 3 to 3.5%. That's where it's going to be. Until the government decides to get serious about cutting spending, the inflation is not going down. And anybody who tells you differently, it's smoke and mirrors. Okay, retail sales unchanged in April. Monthly retail sales were virtually unchanged between April and March. Business inventories dipped in March. Business inventories for March were down 0.1% from February, but they were up from 0.7% from March of 2023. Fed governor vows support for CDFIs. Federal Reserve Governor Lisa Cook said community development financial institutions play a crucial role, calling them financial first responders and enumerating how the Fed supports them. So it's good. Yeah, interesting stuff. So producer price index rises. The producer price index rose a seasonally adjusted 0.5% in April and is up 2.2% from a year ago, following a 0.1% dip in March and a 0.6% increase in February. So it was the largest annual increase since the PPI rose 2.3% year over year in April. So the PPI continued to increase just as we thought it would, but the CPI was a hair lower. So again, everybody broke out in massive celebration. So, okay, so the House Congress is basically busy right now. The ICBA has a whole bunch of backed pro-community bank bills in there. I can't run through all these. There's about like 8 or 9 of them in here, but we've got the Promoting Access to Capital and Underbanked Communities Act. We got the CDFI Fund Transparency Act, Bars Bank Supervisory Appeals Improvement Act, the Small Bank Holding Company Relief Act, Bars Rectifying UDAAP Act, the Bank Loan Privacy Act, which is so kind of interesting. So I think a lot of probably good bills there going through. Whether or not any of that stuff will actually get through, who knows? We'll have to see. Okay, ICBA calls on agencies to reduce excessive regulations. I absolutely agree with this. So in the post on what they call Main Street Matters, ICBA Senior Executive Vice President and Chief of Government Relations and Public Policy, Ann Balser, says problematic practices by transaction-focused large banks have long led to new rules for the entire banking sector, with a recent rash of rulemaking totaling 7,000 pages of new rules since July. So yes, I mean, there's definitely a lot more work that can be done there. Agencies update thresholds for Reg CC funds availability. SEC and FinCEN propose customer ID requirements for investment advisors. The Securities and Exchange Commission and FinCEN issued a proposed rule that would require SEC registered investment advisors and exempt reporting advisors to establish, document, and maintain written customer identification programs. Consumers expect higher short-term inflation and home price growth. I'll talk about that a little bit more in a second. Yeah, and then a couple of reports here from the Fed. The Federal Reserve released its supervision and regulation report, which I am going to go over in another episode. And the FSOC recommends stricter standards for non-bank mortgage servicers. As I said, I'm going to go over that in another episode. Fed's Bowman on bank regulation. More is not always better. Yeah, I believe with that. Court injunction pauses CFPB credit card late fee rule. So a federal judge issued a temporary injunction of the Consumer Financial Protection Bureau's final rule on credit card late fees, which was scheduled to take effect a couple of days ago. So we have this injunction. We'll see what happens there. ICBA to Fed withdraw debit card interchange proposal. So IBA expressed vehement opposition to the Federal Reserve Board's proposal to impose a nearly 30% cut to debit interchange that would leave nearly 1/3 of covered issuers below cost recovery. So, okay. So let's go in. For a second here, let's talk about, all right, let's just kind of finish running through some of this stuff here. Okay, so the obviously the NAR lawsuits was something that I had reported on, and basically, one of the perceived after effects of this was that a lot of realtors could potentially leave the real estate business, and that's still kind of an ongoing thing. Let's see here. What other articles and stuff do we have here? So loans contracted credit unions for the first time in 13 years. So U.S. credit unions' total loans and leases fell for the first time in 13 years during the first quarter. That's kind of interesting. Rising fraud continues to wreak havoc on U.S. banks' balance sheets in the first quarter. So U.S. banks are prioritizing fraud prevention technology and awareness in an attempt to fend off losses to their company's balance sheet. So obviously, banks are subject to all kinds of fraud. I mean, we have check card, wire fraud, business email compromise, you have phishing, squishing, smurfing, surfing, identity theft of customers. I mean, it goes on and on. We have counterfeiting of stuff, all kinds of interesting fraud that goes through banks. So investors' risk appetite jumps to the highest since 2021. Supreme Court upholds Consumer Financial Protection Bureau's funding structure. That's an interesting one. I should probably talk a little bit more about that. Transaction deposit costs turned the corner across U.S. banks in the first quarter. Hedge funds stock buying spikes in April as market dips. J.P. Morgan to acquire about $5 billion in warehouse loans from New York Community Bank. And let's see here. Deposit growth pushes through higher for longer rates. And here we go. Last thing here. So U.S. banks report negative loan growth in the first quarter. For only the second time in the last 12 quarters, total loans and leases contracted across the U.S. banking industry in the first quarter. So negative loan growth, along with a persistently rising cost of funds, caused downward pressure on the industry's aggregate net interest margin in the quarter. So in the first quarter, we basically saw net interest margins decrease, and we saw negative loan growth in banks. So not a horrible first quarter, but certainly not the best either. So, okay, here. So let's see what's going on here. I wanted to talk for a couple minutes here about the FDIC. So, basically, we had hearings on Capitol Hill this week that basically targets the FDIC following the reports of misconduct. So, as I reported last weekend, so FDIC Chairman Martin Gruenberg, he accepted responsibility for reports of misconduct at his agency during a House Financial Services Committee hearing. Gruenberg, who faced questions on the report from Republican and Democratic members of the committee, said he is committed to addressing issues laid out in an independent review of the FDIC workplace culture. The FDIC board authorized the review following media reports of misconduct at the agency. During the hearing, Committee Chairman Patrick McHenry repeated his call for Gruenberg to resign, while Ranking Member Maxine Waters said the agency head is obligated to make sweeping changes. Conducted by Cleary Gottlieb and overseen by a special committee of the FDIC Board of Directors, the independent review found the FDIC has failed to provide a workplace safe from misconduct and that management's responses have been insufficient. Bank director reported it this way: a bomb went off at the FDIC this week. The agency published an independent review of its workplace culture from the law firm Cleary, Gottlieb, Steen, and Hamilton, where more than 500 current and former employees accused their colleagues of sexual harassment, discrimination, and misconduct. Perpetrators were sometimes moved to other offices or roles, but rarely faced discipline. Of the 92 harassment complaints made through the FDIC's anti-harassment program from 2015 to 2023, not a single one resulted in removal, reductions in grade or pay, or any discipline more serious than a suspension. In addition, numerous FDIC employees, including senior executives, noted instances where Chairman Martin Gruenberg, who has been at the agency for nearly 20 years, lost his temper. His demeanor led to a chilling impact on open communications, the report said. So that's how the bank directors were, as a bomb went off. The FDIC, here's another article here. Gruenberg vows to make changes at FDIC following workplace culture. So FDIC has put the gears in motion to improve its workforce culture after a report indicating misconduct. The core objectives that we are trying to address for the agency are to strengthen the ability of employees to report misconduct, to provide independent investigations of misconduct, including by third parties, and to strengthen our disciplinary process so that there is swift and certain justice for victims appropriate to the misconduct that's occurred, including separating individuals from the agency. All right. So here's my take on it. You've got Gruenberg, he hasn't been in charge, but he's been at the agency for 20 years. I want to say that he's been in charge for 4 to 6 years, something in that time frame. So all this has happened under his watch. So I'll put it to you like this. If a bank CEO drove a bank into the ground and then had all of these allegations of from a couple hundred employees of all kinds of sexual misconduct, all kinds of aggravated harassment, all this just crazy stuff going on, and that CEO went to the board of the bank and basically said, "Listen, I've been here for 20 years. I know I rode this bank into the ground, and I'm sorry about that. And I should have paid more attention to all these things and these issues that were going on in turn. And I know our culture is horrible, but just give me a few more years. I'm going to get on top of this thing now, and I'm going to make this right." I don't think that there is any board of directors in the world that would just sit there and be like, "Oh yeah, sure, that's fine. Yeah, let's give them another chance." No, they would say, "Sign this document. Okay, you're not getting any compensation on your way out the door. We're breaking your unemployment. We're breaking your employment contract, and you can exit stage right." That's basically what would happen to that CEO. So the idea of leaving Mr. Gruenberg in charge there at the FDIC, I think, is kind of laughable. Let's just leave the fox in charge of the hen house and just let him continue to monitor security. I don't think that's going to work out too well there. You could also compare it to Wells Fargo, right? When the whole sales debacle thing happened there, you could tell that the deeper issue there at Wells Fargo was the culture. The culture had serious problems. And I think that's why Wells Fargo still has as many issues as it has today, because I don't believe that they ever fully addressed the cultural issues that permeated from that culture. And it goes top down. It does not go bottom up. It goes top and down. It starts from the people at the very top, and they permeate that culture throughout the rest of the organization. That's how it works. So to say that like middle management or lower end people we're pushing this culture or whatever, no, it does not work like that. It comes from the people at the top, and therefore the people at the top are responsible for ultimately the buck stops with them as to what the culture of the organization is. Okay, that being said, so a couple other things here before I wrap up real quick. I just put out the episodes 16 and 17 of the Lords of Easy Money, and that series is rapidly coming to a conclusion. This week coming up, I will put out episodes 18 and 19, which will be the final 2 chapters of the book. And in the week after that, I'm going to put up episodes 20 and 21, which will be the final 2 episodes. 20 is just going to be a recap of section 3 of the book, which was just the last 4 chapters, just because I did reviews of part 1 and part 2. So I figured I'd do a quick, 15-minute review of part 3. And then 21, that episode I'm hoping to be pretty interesting because the book leaves off in 2021, and I'm going to try to cover basically like what's happened over the last 3 years, try to bring everybody current to today, and try to tie this whole thing together off of what's happened over the last 15 years, and hopefully share a lot of very interesting charts and graphs and things with everyone, as well as a few articles that I've been saving recently to kind of illustrate the points of the book. So again, yeah. So I hope people will go and check out some of the other content on the channel, as well as some of the interviews that I've done more recently. I had the CEO interview with Bob White, some interesting interviews with Brian Nestor on health insurance. I'm trying to think what else I had there. I had a couple. I'm kind of blanking, unfortunately, on a couple of the other interviews I had there, but go check out some of the other episodes and things on the site, and that would be great. And as always, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. You could check us out on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below. I always love getting back to everybody. I hope everybody has a wonderful weekend, and I will be back to you next week with another banking update and more really good banking information. All right. Thanks a lot, everybody.